In today's video, I will be explaining to you what capital gains are and what some of the tax exemptions are for a primary owner and a person that's selling an investment property. So if you are thinking about selling your property and you know you're going to make capital gains, you want to watch this video till the end. So let's get right to it. So before we get started, let's define what capital assets are. Capital assets are any kind of property that you own. It could be a car, gold, bonds, stocks, real estate. And then when you sell this asset and you make profit on it for whatever you bought it for and then what you sell it for, that difference is called capital gains. Now there's dictionary definitions out there, but I wanted to keep it as simple as possible. So in today's video, we're going to be talking about capital gains that you make when you sell real estate, which is a capital asset. So when you sell real estate, the profit that you make from when you sell it is called capital gains. Now, we're going to be talking about two different types of properties today. Primary property, the one that you live in with your family, and investment property, may that be commercial, rental properties that you own. So let's get right to the board and get started. So starting off with a primary property. So if you are a single person and you have sold your property, say you bought it for $200,000 and now you've sold it for $400,000 for layman terms, for example purposes, you've made a gain of $200,000 from the point you bought it and then the point when you sold it. So if you're a single person, you have a tax exemption for up to $250,000. So in this scenario that I just told you, you will not have to pay taxes, okay? Now, if you're a married person, I'm going to change the example a little bit. Say you're a married person and you bought a property for $500,000 and now you're selling it for $1 million. If you're a married couple living in a primary home, you have a tax exemption on the capital gains, which are the profits, for up to $500,000. So in this scenario, you will not pay taxes. And then, which you're going to get to know more as we move on in the video, you can deduct expenses. Now, what are expenses? So you have hired a real estate agent to sell your property. The real estate commissions are considered expenses that you can write off on this and lower your bottom line, which you'll understand in an example that I'm going to share. Also, expenses are, say you've done a remodel before you sold the house. So that remodel expense that you've put into the house to get more value, to increase the value of the house, is also a write-off that you can do. And then these are some pointers that you must pay attention to. So say, for example, you bought this property 5 years ago. You must have lived in it for at least 2 years. Now, those 2 years don't have to be consecutive, but in the last 5 years, you must have lived in it for 2 years in order for it to be deemed as a primary property and for you to get these tax deductions that tax exemptions that I just talked about, the $250K for the single and the $500K for the married. And then this is a common question asked a lot. Can you do multiple capital gain tax exemptions on primary property? And the answer is yes, but you just have to wait for a 2-year period. So for example, if you just sold your house in 2022, you can't do another one up until the 2-year mark is done in the year of 2024. So you have to wait 2 years. Okay, then we have investment property. But before we go there, let's look at an example really quickly, closely, to understand how capital gain tax exemption works on primary property. So let's say you are a married couple who bought your home in 2014 and are selling it in this year, which is 2022. Say the time you purchased it, the original purchase price was $500,000. And today you are selling price at $1,200,000. The capital gain on that, which is the profit that you've earned from the point you've bought it to the time you're selling it, is $700,000. Now, the tax exempt gain, which is because you're a married couple, since you're a married couple and it's your primary property, you have a tax exemption gain of $500,000. Means that you will not get tax charged on the $500,000. Then you hired a real estate company to sell your house that charged you a 5% commission, and you paid $60,000 in real estate commissions. All right. Then you also did a home remodel before you sold it, and you put in $100,000 to do a complete remodel. Now, if you add the 60 to the $100,000, and you subtract it from the total gain of the gain that you had that you have to pay taxes on, which is $200,000, the total taxable gain would be $40,000. That will be the amount you would pay the tax on. So in this example, you saw that the person or the family, the married couple, had a $700,000 total gain, out of which $500,000 was exempt, and they would have to pay tax on the $200,000. But they were able to deduct the real estate commissions, and also were able to deduct remodel expenses, and it ended up being $40,000 that they have to pay taxes on. Now, if the gains were $500,000, then you would pay no tax because you're fully covered. There is one thing that a lot of people are uncertain about, because this law was changed in 1997. A lot of people think that when you sell a primary property, you're not going to pay any capital gains as long as you buy the next property. That is incorrect information. It used to be true prior to 1997, but after that point in time, they came up with these numbers where if you're married, you're exempt for these amounts: the $250 for a single person and $500 for a married couple. So if you made more money than that under which you're covered, and you end up buying another property, you will have to pay tax. The IRS is going to come back and collect their money. So just make sure that you understand how these exemptions work. Also understand, ladies and gentlemen, that I am not a CPA. I am in the business of selling and buying real estate. So please consult with your tax consultant, or you can talk to other experts like attorneys and CPAs that specialize in this. But this video will give you tangible talking points and maybe some more to have these discussions, so you are educated before you have these conversations. So let's get going and now talk about investment properties. So if you own an investment property, and you sell it and you're trying to cash out, meaning that you are not going to buy another property, you're going to take the money out from, say, for example, you bought it for $1 million and you're selling it for $2 million, you made that $1 million capital gain, you will have to pay taxes. Okay. Now, the way they assess these taxes, it can be a little intricate, but I'm going to give you some talking points here to kind of give you a basic understanding, and we're not going to get into what the actual tax rates are because they may differ from state to state. So depending on if you did a short-term investment or a long-term investment, when you bought the property, say you bought it under a year, then you might have to pay short-term taxes. If it's a long-term investment, then you have to pay long-term taxes. There's also higher taxes if you are in a certain tax bracket where you're making a good money on your investments. You're gonna have to pay a higher tax there. You have a different tax bracket. Then you also have local taxes that you have to pay depending on where you are. There might be some transfer taxes or city taxes that you have to pay. So like I mentioned earlier, if you don't want to talk to an attorney, and you feel like they're charging you a lot of money, or the CPA that you're talking to maybe is not the right person that you want to talk to, you can actually talk to, here in California especially, you can talk to an intermediary. They're known as a 1031 intermediary company, and they help you with the whole transaction of selling an investment property and can guide you through the process, and their fees are very nominal. So Google a 1031 exchange company or Google a 1031 exchange intermediary, and you'll be able to find a lot of companies that are going to give you really good knowledge pretty much for free. So that's something that you definitely want to look into. Now, moving forward, say you're not cashing out, okay, and where you're now going to take the money that you've made on this property and you're going to reinvest it back into the real estate market. In that case, you can defer your taxes with something called a 1031 exchange. Now, that's something that you want to talk to this 1031 exchange intermediary. And say, for example, you sold the property. Today was the close of escrow where you sold your investment property. You have 45 days to identify the next property and let the government know that you've identified a property. And then you have 180 days to actually reinvest that money into that next investment property. It doesn't have to be the same property. It doesn't have to be apple to apple. You could sell, 5 homes, a portfolio, and then buy a commercial building. It's just that you have to reinvest the whole amount that you got. But again, it's a little bit more intricate than the primary side. Like I mentioned, you definitely want to talk to an expert. But I hope this video today was insightful and you got a good understanding of how capital gain tax exemption works. And like always, we love to create this content for you. So please don't forget to like, share, and subscribe to our channel to stay on top of your real estate game. Until next time, this is Karan saying with Optimal Homes.